Dilution is real. It's something that we don't talk about a lot when it comes to venture capital, startup funding, fundraising, any of this stuff. Nobody talks about the importance of understanding dilution. Dilution is simply when you as a founder are giving up shares in your company. You're not giving up a ton of the company all the time. It really depends on what you negotiate. But you got to understand this concept before you start fundraising and filling up your cap table with a bunch of names and a bunch of different firms. So let's break it down. So what is dilution? Dilution is a reduction in ownership percentage when new shares are issued, right? So to be clear, you're not losing shares. You own a smaller slice of a bigger pie. So the company's growing, but you own less of it. I think that part makes it make sense, right? If you look at a lot of the movies, when they depict this stuff, they're showing the founder upset or they're frustrated or whatever. Usually it's because they were blindsided. They didn't know what's going on. Because first of all, every founder thinks that you have to do this equity trade, and that's not it. You can do credit, all kind of stuff. You got other options, but equity is the most popular because I would argue it's the easiest. But I want to break down what this actually looks like. So let's start off with the math. So let's start off and keep it simple, right? You have two co-founders and it's a 50-50 split. That's how most of these companies start. That's like the basic structure. And right, your pre-seed costs, let's say 15%, right? You're given a 15% equity and the founders now drop down from that 50-50 to 85%. And if seed costs you 20%, right now what's left is 68%. Series A costs another 20%, you're down to 54. A Series B, that costs another 15%, right? Now you're down to 46%. And you got to understand that when you're diluted, like this is part of the fundraising process, yes, but this is also why this dream of having this billion dollar company, this unicorn brand is a little overrated, in my opinion. I think some founders are chasing this because it sounds really good and it's like what you're told venture has to be. But this is also why I'm excited to see venture change, because I think it will be amazing for more founders to raise through other vehicles like credit and different things like that, instead of just giving up a ton of equity. Because then when that exit happens, when you do blow up, and let's say you become a $500 million, $700 million, even $1 billion company, if you don't have to give up everything on the way, you'll be much better off, right? Think about this. I just said at Series B, you're down to 46%. And that's between you and your co-founder. See how split that is? You really got 23. Think about how bad that is, in my opinion. And I know people love to say, would you rather have a smaller piece of a bigger pie? And in some contexts, that makes sense, yes. But all the other things that come with this fundraise, that's part of the problem. It's not always this big win that you think it is. There's some other traps you got to be aware of, right? The option pool and valuation traps are one of those. So investors require expanding the employee option pool before the round closes. This means they know you're going to put money into the employees. You got to take care of yourself and stuff like that. That's what the option pool is for, right? This new pool comes entirely out of founders' equity, not investors. So when they come in and they give you this money and they're getting equity, this doesn't come from their share. It's coming from yours. Again, this is something else that you as a founder just have to be aware of. You got to know this, bro, because I think there's a lot of horror stories out there that we hear about where founders have these bad deals. And this is the kind of detail that it's very easy to miss, right? And something else you got to think about is the pre-money versus post-money. Pre-money and post-money changes your dilution. It's not going to be the same, right? So for example, let's say you start off with 10 million pre-money. You raise $2 million. Now you have 12 million post-money. Pretty simple. 10 plus 2 is 12. Now, the new investor will own 16.7%, not 20%. They don't get anchored on pre-money talk. Don't get stuck up with that, because before you have the money, that's what you're at. But post-money is what really matters, because that's what's going to shape the dilution. You got to really understand this math. And this is why I think it's good to have people in your corner who have raised capital like this before, who have kind of gone to the mountaintop or who study this. I can say myself, have I raised a ton of money? No, but I'm dedicating a lot of time to studying this stuff so I can make this content. And I just love learning about it. And I love helping founders at the different universities and accelerators that I collaborate with. So having somebody in your corner that knows these details, it will save you a lot of headache. So if dilution is inevitable, how do you minimize it? Can you minimize it? Let's get into that. So one strategy is raise less capital, more frequent milestones, and higher valuations. So now if you're not chasing the new rounds every time you don't have to worry about being diluted. Simple. You avoid dilution by not raising a ton of capital. Number two, and this is the one I'm always talking about, is non-dilutive capital gains. Grants, revenue-based financing, I mentioned credit and stuff like that. It's a lot of other options. When you're raising capital, you have to get out of this mindset that it's only about giving up equity. That's the most famous and popular way, but it is not the only way. And third, you have to negotiate your option pool size before signing the round. Make sure you have this discussion with the investors. Usually they'll be pretty open to it. And then I would also say be aware of the numbers. So at IPO, the typical founder owns 10 to 20% of their company. When you see these billion-dollar exits, that founder owns 10 to 20% of that. They don't own 50, 60, 80% most of the time. That's not the norm. And I'm not even saying this is a bad thing. It's just something you as a founder have to be aware of because that's part of the game. I don't think it's failure. I think it's just the price of capital to build something massive. Now, before I continue, I got to tell you about the fundability assessment. This is something I created to help founders understand where they are before they start pitching investors. You can complete it down in the description box down below. It is completely free. Go to raise.nextroundready.vc. Again, it's first link in the description. It's going to score you on 5 pillars that investors are looking for. And it's not something I made up. It's from all the investor conversations I'm constantly having on the Next Round Ready podcast. Go and check it out. One big mistake you can avoid, this is super avoidable, is raising too much money. See, when you raise too much money you don't need, you get diluted more. So if you say, I'm not going to raise as much money, I'm not going to chase that, you can save yourself in the long run. I think a lot of founders raise too much money because they're not thinking about it in the structured way of what dilution actually is in the long run. It looks good right now because you get straight cash and it's wired to your account and you got it, you can use it. But you're giving up equity in the long run. When the company is successful, it's going to come back to bite you. This is also why I've been talking about safe stacking recently a lot. I'm working on a whole video about this because I think something that's going to happen to a lot of founders in the future is you just continue to stack so many safes because it's an easy way to raise money that eventually the combined dilution is going to sink you. You don't even realize it because you have different valuations and all of that stuff. You got all this different paperwork, but you're giving up so much of your company here and there and here. Your cap table is going to be chaotic. And then when you get to the end, it won't be anything left for you. Not anything of substance. And I'm not building a massive company to give it all away to investors. That just sounds crazy to me. Okay, I got to get into some super technical stuff. So don't click away, but this is super important. The anti-dilution provisions really focus on investors and not founders during a down round. I know it seems like it's something that should be for you. It's not. You got full ratchet, which is aggressive. It's rare. Weighted average is more common and founder friendly. That's something you can talk with investors about. The down rounds with these provisions heavily dilute founders to protect investors' stakes. So the investors are always going to protect themselves and they have the leverage because they have a ton of money. The one with the gold makes the rules. Another thing to remember is ownership percentage is not the whole story. Liquidation preferences dictate who gets paid first at an exit. That is huge. The standard is founder friendly is 1x non-participating preference. Aggressive terms will hurt more than raw dilution in a mid-sized exit. Something I know you probably heard of is vesting. Vesting is your co-founder has to stay within the company for a certain amount of time so they can get the ownership and everything. We know what that is. And just as an overview, this is what I've learned from my research on Carter and other stuff like that. The normal equity dilution at each stage is kind of goes how I mentioned earlier. In pre-seed is 10 to 20%. At seed is 15 to 25 or what's left. Series A is 15 and 25 as well. And that's just in percentages, right? In later rounds, it tapers down as company value grows. Now, again, the goal here is not zero dilution. Dilution is okay. I just want founders to be aware of what they're being diluted for. You don't want to give up a ton of your company, a ton of shares and leverage, board positions, all kind of stuff. And you're not getting anything back. So in my next video, I'm going to talk more about what you should expect from investors when you're building that relationship and kind of how you interview them when you're ready to pitch. But to make sure you're ready for that, you should complete the fundability assessment. It's the first link in the description box down below, raise.nextroundready.vc. And make sure you complete every question because it's going to score you on 5 different pillars that investors are looking for when you're raising capital. I'm Chris. I'll see you next time.